Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm back with another weekly economic review, this time for the week ending April 15, 2022. So, shortened week. Tomorrow will be Good Friday. So, I'm recording this on Thursday. So, this is as of the close on Wednesday. So, 3 days here. Negative for bonds, negative for stocks. Of course, regarding bonds, it's hard to imagine positive weeks when you have the Bank of Canada hiking by not 25 basis points, what like it usually does, but 50 basis points. So 2 in 1 for this rate hike. So year to date, we're at minus 8.5 almost for the universe index, minus 15% for the long index. And as I'm recording this, markets are open and rates are up again. So probably it's going to be worse than that for bonds. Within equities, well, our strategy is to be neutral equities with an overweight in Canada and EM, underweight US and EFI. So when you see a spread like that, it kind of helps our performance to be more underweight the markets that are underperforming and overweight those that are outperforming, although to the downside. So we think this is the place to be within equities right now. Focus on the commodity exporters, so Canada and emerging markets, or more specifically Latin America. So this is how we're positioned, and markets are behaving accordingly. Price of oil higher. Lots of volatility on oil over the last few weeks, mostly about China. So we have lockdowns in China, and then we have some reopenings left and right. So the prospects for demand for energy, this is what's driving the market. So it was up 6% this week, the price of oil. So the topic of the week, and I'll cover only this one, the Bank of Canada, we had a 50 basis points hike, so 0.5%. As I said, 2 hikes in 1. So the last time we had something like that was in May of 2000, so 22 years ago. That was the dot-com bubble, the peak of the dot-com bubble even, and the economy was overheating. So central banks were slamming the brakes, and this is the same thing that we're seeing now. The economy is doing very well. We're seeing excess demand on the Canadian economy, and inflation is at 5.7%, so way above the 1 to 3% target range that the Bank of Canada sets. So this is its objective. So inflation is too hot. The economy is doing too well. So central bank, it needs to normalize and to tighten its monetary policy. So now rates are too low. They're still stimulating the economy. So that's why they are being pretty expeditive in doing that. So we had a first rate hike. Now we think that there's another one coming in early June. So June 1st, we should have that. And then after that, in mid-July, do not exclude, and we still think it's the base case even, that we'll have a third 50 basis points rate hike. So needs to go pretty quickly, and the idea is that it needs to, central banks, Bank of Canada, Federal Reserve, every central bank in the world, they need to send a strong signal to everyone that they're serious about bringing inflation back to their target of 2%, because they're risking an inflationary spiral if they don't re-anchor inflation expectations. So in very clear terms, if households, if businesses are starting to expect inflation to remain at 4, 5, 6% for a good while, for many years, then they will have some labor contracts that will be signed with 4, 5, 6% inflation embedded into them, supplier contracts, and then we'll have a self-fulfilling prophecy of inflation staying at these levels. And it's going to be very, very hard for central banks to bring that back to the range of 1 to 3%, which is their mission statement. So that's what we're seeing here. So the Bank of Canada went. We had the Bank of New Zealand also going with the 50 basis points, and the Fed, the Federal Reserve, should go with its own 50 basis points hike on May 4th. So in 3 weeks, so more of that coming. So again, headwinds for the bond market. So a few tables of interest from the Bank of Canada. So we had also the monetary policy report, which is their document that I always encourage people to take a good read if you want to understand what's going on in on the economic sphere. So inflation is expected by the Bank of Canada to remain elevated into 2023. So here, maybe just focusing on the red box that I put there. So you can take your time, look at this data after. But the forecast for inflation by the Bank of Canada is that in 2022 Q4, so at the end of this year, Now they're expecting inflation to still be sticking at 4.5%, so way above their target. And the number of parentheses, the 3% that's in that just below, that's what they were forecasting in January. So that tells you that it's all about the impact of the Ukraine invasion by Russia on commodity prices. So I mean, most of everything that we consume, that we buy, has been transported by a gasoline engine at some point. So higher prices for oil means more expensive gasoline, means higher prices for many things. So that's one of the channels, one of the main channels. So the revision is pretty steep here, and it takes all the way to 2023, second half of 2023, before we're within the range of 1 to 3%, and it's expecting that we'll end 2023 at 2.4% inflation. So even if they're going really boldly at first, it's still going to take a while before inflation comes back. So there's always a delay in the transmission of monetary policy. And here, that's why they need to act very, very aggressively at first, because they know that there's a delay and you don't want inflation to stick around at too elevated levels for too long. Maybe just an infographic also from the bank about the impact of the Ukraine invasion. So higher commodity prices mean, of course, that inflation is pushed higher on all fronts. The real GDP column, it makes sense. It is an immediate assessment, I believe. If you look forward maybe 1-2 years, more revenue for the government because commodity prices are higher and we're a net exporter of a lot of commodities. And I think more revenues for businesses. I think that's actually a tailwind. It's not neutral for the Canadian economy if you have an horizon of 2-3 years ahead of us. But right now in 2022, I would agree that it's pretty much a wash. So the question is, well, if they're slamming both feet on the brakes, does that mean that the economy is going to crumble? Well, no. Their risks of a recession are rising. If we have a recession, probably it's going to be somewhere in 2023, 2024, and it could be a technical recession of just 2 consecutive quarters of, let's say, negative growth, but slight negative growth. That would be my base case today. Let's see how things unfold. But when you look at the forecast here from the consensus of Bloomberg economists, 2022 on the left, you can see Europe, the US are being revised lower, and they're still being revised lower. Canada is still expected to deliver good growth, about 4% here, which is close to what the Bank of Canada sees. And in 2023, slower growth than in 2022, but still an outperformance from Canada. So overall, we still think that Canada is in pretty good shape. That explains why we also like the Canadian stock market. So next week, we'll have our CPI inflation figure. In the US, we had theirs in March, for March this week. It was still accelerating, so probably we'll have an acceleration in Canada too. Last month, we were at 5.7%. We'll have the Terranet National Bank home price index. We'll have the retail sales figures coming out. And in the US, it's all about housing. So housing starts, building permits, and existing home sales. So that wraps it up for this week. I wish you a very happy long weekend, Easter weekend. So I'll be back again next Friday with another edition of the weekly economic review. In the meantime, ia.ca/economy. You can find us on Twitter, on LinkedIn. And again, there's some new content for the Economy and Finance 101 coming up. So stay tuned. Thanks, everyone. Have a good weekend.